All right, so if there's one massive loser in the budget, it's business owners, particularly small to medium business owners. And the problem with that being is that's the vast majority of businesses. In fact, all businesses are that, and a very small number of them become medium or large businesses. So the vast majority of businesses are always small businesses because the vast majority of them fail. And even the ones that survive stay small. Most businesses stay relatively small. So why are businesses being targeted to this? Well, there seems to be a bit of a fundamental shift, or there's an ideological sort of, I guess, undercurrent in the sense, and the Treasurer spoke about this, suggesting that those people who earn their money via trading, essentially, so realizing greater value for an asset, let's say a business in this case, versus those who earn their money by, essentially trading their human capital for wages, should pay similar rates of tax. Now, we've done a long video where we talk about some of the pros and cons and the stuff around that, so I won't go into that in a lot of detail, but suffice to say, the short version of that is the two things aren't remotely the same thing by any stretch of the imagination, and all other countries in the world recognise this. So why Australia is suddenly doubling, going from one of the lowest capital gains tax, in fact there are countries with zero, but of those who charge capital gains tax, one of the lowest, to outright basically the highest, and not only doubling the rate, but the effect of that doubling, when you apply that to real life cases, is going to be a multiple of increase. It could be 90% or more increase in the amount of tax payable as a result of these changes. So we're going to see some very extreme additional tax liabilities as a result of these changes sort of moving forward, which will have an impact on people deciding whether they set up a business at all, whether they set the business up in Australia, how they structure their affairs is going to have a huge impact. But the real losers of this actually are going to be the active businesses. So those investment trusts, if you like, trusts that are largely just investing in passive assets, they've always been a relatively limited time frame, limited scale structure from a tax planning perspective. They're way more about asset protection. But those businesses, the mum and dad businesses, the family businesses, the small 1-2 partner businesses that make $100,000, $200,000 a year profit and distribute that out to supported family members, they're the ones that are very much in the crosshairs of this. Not only are they going to be taxed more on their earnings because they won't have the ability to distribute income the way they have in the past, because that's absolutely what they're targeting with this minimum 30% non-refundable franking credit, essentially. So it's essentially trusts being taxed as companies, but without the refund of franking credits if the average or marginal rate of tax is lower. So they're very much in the crosshairs. But the other thing that it's penalising is those who are essentially realising that value at some point in time. So the difference, and again, we've gone into this a lot of detail in a long form video, but appreciate that there is no such thing as capital gains tax. There's only the portion of that gain that's included in the tax return in the year of realisation. So again, if you realise a $100,000 gain in this year, ignoring indexation for simplicity, but that $100,000 gain now goes in the tax return as opposed to 50% of the gain going in the tax return, which is the current rules. Someone earning the $100,000 in that year is also putting $100,000 in the tax return. So the effect of that is the same. That's true. But that earnings was earned in a year. That $100,000 gain may have been earned in an afternoon, may have been earned over many, many years. We're not spreading that earnings over the time frame that it was earned. And the earnings were not guaranteed at any point in time until that gain was actually realised, particularly in terms of a business. So there is no guarantee when you start a business that the business will succeed. Most businesses, statistically, most businesses fail within a couple of years. As high as 90% of businesses don't last 5 years. So the idea that reward at the end, potential reward at the end, and the survivor bias that comes from only looking at the businesses that have made it and have realised that gain and have realised all of that gain in a single year, similar to selling a single investment property with $1 million gain that you've held for 30 or 40 years, selling at the end of that period of time and having a massive gain in a single year, not because you were rich through that period of time, but because 1 year you had a very large spike in income. You're in the top 1% in that year, you're a very high taxpayer. You weren't in that bracket any other time in your life. You're just realising that at this particular point in time. And the other downside of that to that business owner is because they're only able to realise the vast majority of their value at the end of that period of time, they're not able to spread that over all of those years where they didn't have any earnings on those low marginal tax rates that the taxpayer who earned $100,000 over 10 years to make their $1 million was able to do. So the idea that they're equivalent is not even remotely true mathematically, let alone from a relative risk and incentive perspective. So that's the real problem and the real reason why not just current small business owners, but especially future small business owners are massively disproportionately affected by this change in tact, if you like, in terms of the capital gains tax discount, coupled with the fact that discretionary trusts are essentially going to be taxed at a minimum of 30%. So, and that capital gains themselves are going to be taxed at a minimum of 30%. So there's no way of not paying a minimum of 30% tax on the real amount of gain as an absolute minimum is going to, and good luck keeping that below other thresholds, but is really going to make Australia a very, very highly taxed jurisdiction for capital. And in an age when capital is increasingly intellectual and therefore mostly mobile, sets a very dangerous precedent about what it says to what people should do in setting up businesses in Australia. So yes, small businesses are by far and away the biggest losers in this budget. So hopefully there'll be some sort of recognition of that at some point and maybe some sort of changing to this policy because it's very, very counterproductive for small businesses. So those of you who are caught up in that from a trading perspective, again, not from an investment perspective, trust that we can deal with that relatively easily. Trading perspective, you really do need to start looking at that ASAP, to start looking at how you might restructure your affairs. It's interesting that the small business tax concessions, so those, with an asset value less than $6 million or turnover less than $2 million, those concessions haven't been touched. So there's still this recognition that you build up your super over your lifetime or building up the value of your business, you should get that portion of that gain free if you meet those concessions. But any other businesses that don't, somehow don't sort of meet that. So that's a very interesting policy position. So again, watch this space. Does this mean that small business concessions are at risk? It doesn't appear because they didn't sort of do that, but sort of who knows? It's a very interesting policy position to not change those provisions per se, but have a whole bunch of other conditions that will tax gains, especially for small businesses. So if you have an active business run through a discretionary trust, you do need to talk to your accountant, talk to us ASAP, but for those of you who have discretionary trusts or run businesses through companies, then there's no major change at this stage. We've got time to make the changes necessary to restructure, and there will be relief from any sort of short-term tax penalties as a result of that restructure.